All right, everybody. Thanks for joining us on this crazy week we've had. Anyway, this is going to be another option strategies for beginners or intermediates. It does carry a higher risk tolerance, but it is very easy to learn. So one of the things we're trying to balance with all of this is these strategies, whether or not they're easy to learn or easy to kind of implement and take into account your risk tolerances in a sense. Now, this does carry a slightly higher risk tolerance, and you need to be pretty aware of that, because just like buying a stock and it goes down, you lose money. Just like buying a synthetic long and the market goes down, you lose money. This, if the market goes up, we're going to lose money, because this is a synthetic short strategy for bear markets. Now, would have been able to profit pretty good this week from obviously a synthetic short or synthetic short position in an underlying. The beauty in this is there's a lot of benefits as opposed to going out there and shorting a stock. And we'll talk about that a little bit more further on. But I really like to use the short stock position using options rather than going through all the rigmarole that you have to go through when you're trying to really short a stock. So this is a great strategy to know, and it is a good one if you like to trade futures or even stocks, like literally trade stocks, buy stock, sell stock, things of that nature. So this is a really great strategy to have in your quiver. Is the market afraid of the Trump interview? Trevor, I don't know if it's afraid of that. Now, what did FID do? I don't know what that means, Noel. I think the markets are really kind of getting driven by some algos right now. I think a lot of paper is getting pulled out and the algos are kind of driving around. And it's interesting, today's low came at the announcement of Fidelity saying that they were no longer going to allow their clients to sell options. So that's what I'm talking about. Fidelity came out and said they weren't going to allow their clients to sell options. Now, there's a lot of things that go into this. You know, for one, they don't know what their clients' risk tolerances are. Two, now they're just basically talking their clients into buying options in high volatility, which is absolutely the wrong kind of situation you want these guys to get in, because now they can be directionally right. Volatility comes out. We've seen how fast volatility can come out when it's this high. And these people are just going to get smacked in the face when the volatility sucks out. But they announced like almost to the minute on the low today. And the market just turned around and ripped higher. So, you know, what caused all of this? You know, some of it had to do with, it was a squeeze on people selling puts and stuff like that. You know, you guys watch my daily market commentaries. I got pinched on some of this after the bounce, and the retest is when I got pinched. But anyway, at the end of the day, they don't know the risk tolerances, and they shouldn't be making those decisions. Now, you know, I've talked to some other people also, and one of the things that came up is maybe they're just likely trying to protect themselves and spin it to say they're trying to help out their clients. But anyway, I got on a little soapbox there. That was almost the catalyst for the rally as far as I'm concerned. And the rest of it has to do with the markets are trying to throw a tantrum to the Fed to say, hey, stop raising rates, which they always do. All right, so I see a bunch of guys blowing me up on some questions. So yeah, get a new broker. That's what I said on Twitter today. I was like, a lot of Fidelity people are right now like shopping TD Ameritrade. I said just looking for a new broker. We're starting right now. Actually, I'm getting on a soapbox about the markets right now. Sorry, Lewis. I'll get you started here in just a second. Anyway, all right. So let me get a couple of things going. So this is creating a synthetic short position. Now, there's, like I said, a lot of good things that go along with this, but let me get something out of the way real quick. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now. I actually started out trading in college. Then after graduating, started out trading in college when I had a psychology degree, then switched over to finance and then moved to Chicago. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options, basically on all of these products in all market conditions. And now I'm basically at the point where I only trade options. I don't trade really futures or anything else. I always tell people I am a recovering futures trader. Anyway, any opinions, news, research, or analysis, or other information contained here or material provided by ProTrader Strategies and associated companies or employees is provided as general commentary. It does not constitute investment advice or solicitation to buy or sell any securities strategy. Blah, 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 right? And this goes back to what we were just talking about with Fidelity, right? How can I tell you guys what you need to be doing? I don't know your risk tolerances. I don't know what's in your portfolios. So what I'm doing may be counterintuitive to what you guys are doing. And I couldn't possibly say that what I'm doing or what this particular strategy is may or may not be appropriate for you. Okay, so I just can't possibly do that in good conscience. Anyway, bottom line is do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, you guys can follow me on Twitter. I've been a little bit more active lately. When the markets get like this, then there's just all kinds of fun stuff I can talk about, I guess. But you can follow me at Wolfman's blog or the parent company at ProTrader Strategy or at ProTrader Strat for all kinds of good market wisdom and things of that nature. All right, so why deal with the hassle of selling a short stock when you can create it with a synthetic short stock, or why deal with the hassle of selling a stock is what I should have in there, when you could be creating a synthetic short stock? That's legitimately the way we should all be really thinking when we're bearish on something. And bearish enough, you got to be really bearish on this, right? Because remember, directionally wrong is going to be dollar for dollar. So if this underlying goes up by $1, you're going to be down by that dollar, okay? So for every dollar move, you're going to be down. And remember, when we're dealing with options, it is equivalent to 100 of the underlying. So it's like if you were short 100 of the underlying and it went up $1, you are down actually $100. And that's the same thing that goes here with this strategy. So there is a high risk tolerance needed for this. But I would say that you have to have a high risk tolerance for being long stocks. I mean, think about it today. I mean, if you were long stocks last week, you are not very happy today. And that's the same thing that goes with any one of these. You get long, you get short, you are dollar for dollar equivalent to what the underlying is doing. You know, we may be a couple of pennies off, but a lot of times it is dollar for dollar, okay? And that's what we're going to be working on. All right, I see a bunch of questions here. Let me try and get a few out of the way. Is there audio yet? I believe so. Is anybody? Lewis is having trouble. Is anybody else having trouble hearing me out there? Not really sensing fear out there. JQ, I think there's some scared people out there. How are you supposed to do covered call if you can't sell the call? Well, if you're doing a covered call, they'll let you do that. They don't want you to sell naked. If we're talking about Fidelity, they don't want you to sell naked strategies. So a covered call, because you are long the asset, they would let you do that. Trevor, any adjustments? I don't know what you're saying there. Okay, so everybody else, you guys, if anybody ever has a problem, like Lewis is saying, he's having a problem with audio after I did the test. A lot of times what you have to do if you don't have audio is log off and log back on. That would be the best way to do something like that. Let me just send him a note real quick. All right, so I think that went out to him. I'm not sure, send privately. All right, so if you ever have a problem, just log off, log back in. I mean, we have been pretty close to capacity on our room here, but hopefully you guys will be able to get back in and back out, or back out and back in. All right, are you saying that we can short a stock and short an or short an equity option? John, what I'm saying is you can short a stock. We are synthetically, though, using options to synthetically short an underlying, and I'll go over the benefits of that as well. Okay, selling options by people who don't know what they are doing, i.e., majority, is a very dangerous practice. Farshid, I can't agree with you more. And I think that people that are with Fidelity probably are likely some of those people that really don't know what they're doing and are just kind of shooting from the hip. Any adjustments to the synthetic position? There's really not. Just like, if you buy a stock, there's really no adjustments there unless you do like dollar cost averaging and stuff like that. But I'm not even a big fan of dollar cost averaging unless you are a seriously long-term trader. And if you are, then at that point, I would suggest not use options for that type of thing, because you're going to be holding on to that position probably for 5-10 years or something like that, right? So to this, we are your way to stay mechanical with this is to know where you're getting out on a profit and where you're getting out on a loss. Okay, so that's how we're going to play this. Is we're going to try and find a high risk reward ratio on it. What stocks would be best to do it short? Okay, we'll talk about that here in a second. When and a couple other ones. This synthetic short stock involve a short call, which is unlimited risk. It does, yes, which is why it has unlimited risk to the upside. Just like a stock has unlimited risk in a sense. If the stock goes to zero, that's, it's not unlimited, but it's going to feel like it. And if you short a stock and it goes up 10, 20 points, that's going to feel like it's unlimited at that point too. But I'm not going to, we're not going to really see stocks open up, 10,000 points higher unless you're doing this in Bitcoin, and I don't trade Bitcoin. Okay. I think I answered everybody's now. All right, so let's get on with it real quick, because I think I'll answer a lot of your questions through some of this anyway. All right, so synthetic short stock, it's great for overbought stocks when they've gotten a little overextended, which we've seen in the past couple of months. When we were talking about this is it's getting a little frothy. If you watch the daily market commentaries, I've been talking about this for some time. Or you have a bearish assumption on something. Somebody's come out with bad earnings, or you just don't think their products are up to par anymore. That would be a good time to get shorted if you're really bearish on this underlying. All right. So bear markets, if we ever get back into a bear market trend, then this would be great for a bear market trend, just like the synthetic long we talked about in a bull market trend. Those things are great because it's just like going out and buying stock, but you're using a lot less margin is one thing. Pairs trade. So if you are long, let's say you're long Caterpillar in your portfolio and you wanted to do a pairs trade, you could do like a synthetic short with Deere and do that pairs trade that way. They're pretty equally priced. Last I checked, I haven't looked in a while, but something like that. And you can do a ratio of it. And I talk about pairs trading in a webinar and how to come up with that ratio, but you can trade those against each other so that you have a nice pairs trade on, or for hedging purposes, which, just hedging any type of position. The other thing is, so like with the hedging position, you're long the stock and you don't really want to sell it, but maybe you see something on a technical move where it looks like it's getting ready to go down. Well, you could throw on a synthetic short around if you were long Caterpillar and you thought Caterpillar was topping out, was going to have maybe a small correction or something like that. You can hedge that by selling synthetic short stock against it and capitalize on that downturn so you don't really lose money. Portfolio delta adjustment. Now, this is huge for a lot of people that have portfolios, right? Because we have a lot of stocks in there, whether it's our IRA, our 401k, or, a lot of people can trade their 401k these days, IRA, 401k, or just a regular trading account. we have a tendency to get long deltas very quickly. And you don't want to necessarily be long all deltas, be 100% long deltas, because you're held accountable for the market going up, or, and if the market goes down, you're going to be hurting. So portfolio adjustment, adding short deltas to a portfolio. So always have, that's always a good thing. It's always a good process in your portfolio, is to make sure you have short deltas. And it doesn't matter, what you have in your stock, in your portfolio. You just need to start adding short deltas for something that you see that looks bearish in a sense. So always try and mix that up. I don't care if you're, net long deltas because you're bullish, but you still need to have some protection. And by doing that, look for some stocks that have some downside potential. All right. All right. So I think I skipped one. Here we go. Same risk as short stock position. That's 1-to-1, right? If the stock goes down 1, we gain 1. If the stock goes up 1, we lose 1. It's the same risk reward ratio, but it uses 50% less buying power, you guys. So if I was going out there and I wanted to short, let's just say SPY, for instance, if I was going to short SPY right now, it probably cost around, for a 1 lot or 100 lot of SPY, it would probably cost me around, I'm thinking it's probably around $12,000 to $15,000, okay, for margin to put up for that. And that's on an ETF. If I were going to do a synthetic short position in SPY using the options, it'd probably take about 6,000 in margin. Okay, so much less margin on this one. Now, one thing that a lot of you guys are probably going to be asking about here in a second is with this short call. That takes a high risk tolerance, right? Short calls aren't appropriate in an IRA, okay, because people that made those rules believe the market never goes down. Well, so you can go out there and make this IRA legal by just going out there and buying the first call for like a nickel. It's going to be a long way away, you guys, and I don't want you to think that that's really defining your risk, because if it gets to that short or that defined long risk call, you are not going to be very happy with me. So at the end of the day, don't use that as a crutch, or don't use that as your out. It's just using that to get around the bylaws of the IRA, where you can't have short calls in an IRA. All right. It may very well limit your margin as well, because in an IRA they take excessive margins. So it may help you out there too, but you're going to have to look at that yourself. But you can go out there and buy the first call for a nickel. It doesn't really cost you anything. And when you take the strategy off, just leave those long calls on. And even if they're worthless, stranger things have happened. If you guys watch the daily market commentaries, I've been doing this with my IRA, and I have all these long puts on from doing these strategies where I was selling like short put spreads, and just there was no sense in taking off the long calls, right? Because they were a penny. Or why would I long put? I have all these long puts on, and I was like, why am I going to sell these long puts for a penny? I just used them for my IRA so I could save on margin. I'm just leaving them, took off the short puts, and now they're all basically, we're making money. So, sometimes that stuff is all working out. Let's see. What else? I see a bunch of them. This synthetic short about unlimited risk. I think I answered that one. If you had to choose between short delta and long delta, which one would you choose? Farshid, I am a consummate contrarian. So, when the market's down, I want to be long deltas, and when the market's up, I want to be negative deltas, and take advantage of some correction. But that's the cross I bear. Can you repeat the part about SPY costing 12 to 15, but something costing only 6. Yeah. So here, as a matter of fact, here, let's just pull it up real quick. I'm gonna skip ahead real quick. So, all right, we got SPY because I was watching this like a hawk today. All right, so SPY, let's just say I wanted to go out and sell SPY. So it's going to default me to 100, and I'll just hit the confirm and send here. So the buying power effect on that is 13,000. Okay, so let's just see what the buying power effect. So we're doing 61.50. So let's just do the 62 puts. So I'm going to buy those, and I'm going to go and sell the. That's how you set up a synthetic short. So I'm long the puts, short the calls on a one lot. Let's just make it a one lot so we can compare apples to apples. Because remember, each option is worth 100 of the underlying, each one lot. 49 deltas, 50 deltas, we got 100 deltas. Now watch this. So our buying power effect is 6,000. So legitimately 50% of what it would cost for me to go out there and sell this short or just do the SPY. Does that make sense? Sorry, I missed the first 10 minutes. I had to shovel snow in Canada. Synthetic short stock is made of a long put and a short call. Yes, it is, Wally. All right. Would you have a reasonably close long call as a stop loss anyway? Well, it depends, Farshid. That's a great question. If you don't do that one that's way out there for like a nickel, you have to make up more to the downside in order to cover whatever you paid for this option. If I paid, $6 or something like that, I'm going to have like $5-6 to the downside to get to break even. So it doesn't really make sense for that. I would say there's other strategies that you could implement around that for the down bearishness if you were worried about that. I keep track of it, so I'm not going to let it go that far. I'm watching it on a daily basis. If you guys aren't watching on a daily basis, then this may not necessarily be appropriate for you because it could go bad. Just like if you were a long stock and didn't watch it this week and came home one day and saw that it was down 10%, that can happen. What about selling a call and buying a call? If you're selling a call and buying a call at the same, you're just offsetting them. Now, if you're selling a call and then buying a call further out the expiration cycles, then that's a different strategy. Basically, you are doing a calendar. Does that make sense? What were your strikes? All right, I'll talk about those in just a minute. Let me get through these spikes. Watching it isn't going to be helpful, but there can be a real quick spike, and watching it isn't going to be helpful. Well, yes and no. To each his own. I like, I've been doing it for 20 years where I sit here and watch them, so I guess I watch them all day long, so it doesn't really, affect me as much. But if you're working a different job and trading on the side, then anytime you're trading option or anytime you're trading stocks, even you need to keep an eye on it in a sense. But if you're away, do this really small to get your feet wet if you're thinking about doing that. Oh, selling a call and then buying. You could totally do that if you were bearish. Doing a short call spread and high volatility, then yes. And that's a higher probability strategy, Win. So he's saying, what about selling a call and then selling a call and then buying a lower strike same week, buying a lower strike. So then you're basically buying a call spread. So you would be bullish. But if you sold a call spread, that would be good for a high volatility market. You need tier 3, level 3 approval for this at last week's strategies using brokerage firms. Thanks, my good friend. Wait, Toss, you need to have tier 3 level approval with this, with the synthetics, you know I have that level. I have that level of approval. So that's something Shady Tree, my good friend, came out and said that you need to have tier 3 level approval at Thinkorswim to be able to do synthetic longs and synthetic shorts. So you might need to reach out to them if you're interested in this. But you probably have to have some kind of high level tier to be able to short a stock too, right? Yes, a bear call spread win. And I've done webinars on that, which would very well be appropriate in and around this type of environment, high implied volatility. Okay. All right. So let me get on with this. You guys, I'm almost out of time already. All right. So avoid. Okay. So another benefit is when you borrow stock or you get short stock, real stock, there's borrowing fees involved. You're going to avoid that. It's going to cost you about the same for the, your commissions. It's maybe a little bit more expensive with the options than the outright shorting the stock, but you're also going to have borrowing fees in there. And you'll have to also pay the dividend. So there's a lot of benefits with this. You're not going to have to pay that dividend when you're short the stock. You do. All right. What was that? Yeah, so yeah, tier 3 is also shorting a stock for anybody for the most part. Need level 3 and approval for margin. Yes, you may very well. I have all of those credentials, and so you do need to make sure. And I think all you have to do is take a test. You have to take a little test. And after one of my webinars, you guys should be able to nail that test. Trevor, I'll talk about that in just a second. Give me a minute though, all right? All right, so we're going to sell the at the money call, and then we're going to buy the at the money put. Now, Trevor's asking, why do you do those at the monies? Well, the at the monies are going to be the ones that get you closest to that, 100 deltas. Usually it'll get a little wanky when you get further away a lot of times. The other thing is, when you start getting deep in the money, a lot of these options are going to get really wide. And you guys remember one of my rules that I'm going to go over here in a second, picking the right underlying with this strategy, right? Remember my rule. I know you got a lot of returners here. The rule I usually have is a stock under $100, okay? The bid ask on the option montage should be about 10 cents wide. Anything over $100, you just move the decimal 3 ticks to the left, and that's how wide those markets should be. Now, for instance, we were looking at SPY. That would be move this decimal point 3 ticks to the left, 26 cents. These markets should be inside of 26 cents. You can see SPY as well inside of that rule. This week, though, you guys, a lot of these stocks, we got 100% IV all the way down. Look at that. I mean, 90, I'd probably say 3/4 of my stocks are above 90 or more. I mean, maybe even more than that. Super high implied volatility. What happens in high implied volatility? Something like Adobe that usually fits this rule, it would be 18 cents wide. They're 30, 45 cents wide. That's because of volatility. That has to do with risk, you guys. Las Vegas Sands, I mean, we're almost at $1 wide now. Oh, I'm looking at the 70s. But these are still going to be pretty wide. 10 cents wide, not meeting that rule. Las Vegas Sands generally has that. So right now, when we're looking at these stocks, when you get into this really high implied volatility all around the markets, these bid asks are going to get a little wider. Why? Because there's risk involved, right? The guy that is trying to sell or buy is probably trying to offset some of his risk, hedge his risk. And so now that the markets are jumping all over the place, if he buys, let's say, this call and he is trying to offset that somewhere by maybe shorting the underlying or something like that, he needs a little bit of buffer because the markets, as we saw in 20 minutes, the Dow rallied 600 points today. That being said, there's a lot of risk in there. So the bid ask is going to get a little wider when the markets get really crazy like we've seen this week. Nobody's going to make those super tight, and that's the nature of the beast. So that rule doesn't always apply in crazy markets, but the reason why we want to get involved in an underlying that has tight bid ask is for this exact scenario where when the market gets wild, it's gone outside of 10 cents, but it's inside of 20. So take that to the other one where if you got involved in a stock where there wasn't a lot of volatility or it was average volatility, let's say, and the bid ask was 50 cents wide, which a lot of times people are like, let's trade this stock, and the bid ask is 50 cents wide. The stock's $70 stock, and we got 50 cents wide here. Well, what happens when the volatility expands? Well, then those markets are going to be even wider. They're going to be like $1 wide. And if you wanted to get in or out during that time, you have to give up a lot of edge and a lot of yield to get in and to get out. So make sure that when you're doing this, you are involved in a stock that has a lot of volume and open interest. And so, for instance, if something like this were to happen, you saw it was outside of my rule, just go back and check the volume and open interest. You can see there's a lot of volume and open interest here, a lot of volume and open interest. That means, generally speaking, those bid ask are going to be pretty tight. And the rule applies to, the nearest month to expiration. I usually look at 35 days, but you can go in a little tighter. 35-ish days is kind of where I'm going, though. Then the next one is picking the right picking the right strikes. The at the monies. The reason why we want to use these at the monies is, like I said, if we look at the deltas on these, if I was going to do a synthetic short here, these deltas are not necessarily going to line up. If you look at the 10 deltas here, 85 deltas here, that's only 95 deltas, whereas if I do this one right here, that's 100 deltas. So that's what we want to start out with, is 100 deltas, basically. And that's why I pick these. And you do it for a very small credit or a very small debit when you're doing these. So that when it's trading the 71s, I should be able to do this where I go out and buy this put, let's say sell that put there. So Las Vegas Sands, I get it for 98 cents. And if we add that 98-cent credit into the strikes, we're basically shorting this at $70.98. So very close to where it's, mid-market or where it's trading. So that's why we like to do that in and around there. Very small to get in and out. Could you please reapply your rule? Yeah, give me 1 second. Is it generally a good practice to buy volatility when it's cheap and sell when it is expensive, like now? Absolutely, Farshed. It absolutely is. So, is this the right strategy for this environment, being high implied volatility? Well, the beauty in it is that we're offsetting volatility. If we look at volatility here, we are selling this volatility. So we're selling a 9 volatility, and we are buying a 9 vol. So we are offsetting our volatility here. So it neutralizes it. So this strategy can be used in any implied volatility environment because we're offsetting it. We're putting it in the box. We're boxing it in. It can't hurt us because if it goes down, it's going to be offset by the other side. Does that make sense to everybody? This one doesn't necessarily need to have high implied volatility or need to have low implied volatility, okay? Because we're offsetting it. Like most of my other ones that I talk about, there's a specific environment for volatility. All right, picking the right duration. The right duration, you can do this inside of 30 days. I like to go out here pretty far because if I'm isolating volatility, I'm isolating theta decay. Why not take advantage of getting out here on the curve? It won't always get you right there to where the underlying's trading for the break even the further out you go. Like if you're inside of 35 days, it's going to probably pretty much pin right around where the underlying's trading. But sometimes you will get out here on the curve, 70 some odd days, and you may have a little work to do to get to your break even. But having said that, there's also other opportunities out there where you're going to be selling this underlying short higher than where it's currently trading. So we can take advantage of that as well, especially when there's pumped up volume in the puts. Anyway, picking the right duration. So we want to get out here on this curve, okay? Sorry, I'm trying to check on my thing here. All right, so picking the right environment. Like I said, a lot of times I talk about volatility, things of that nature. The right environment for this is going to be offset for most all of them. So we can almost strike this one out, but if you guys watch many of my videos, you know I go through all of these straight through and have something for each of them. The right environment here is ultimately our directional assumption, right? Where we're picking an underlying that is in an environment of going down or getting ready to go down, I guess. And know your guys' strategy before entering the trade. There's no limit to the risk we are going to incur to the upside here. So we need to write it down. You know, I talk about this all the time, you guys. I have books here right next to my desk, right next to my keyboard, where I write down every day what trades I put on, why I put them on, what the, different things that are going on in and around high volatility, things of that nature, and where I'm going to get out. Before I even enter the trade, I have that written down because I'm going to be looking at stuff like, I'm going to be looking at stuff like, support and resistances. I do the same thing you guys do. I'll throw up Fibonacci, and of course I don't have a Fibonacci right now. I'll go over here and throw some stuff on with Fibonacci. I'll just kind of quick and dirty kind of slap that up there. I'll use those. All right, well, I'm going to get synthetically short. And if the underlying, comes down and touches the 200-day, I'm going to be out. Stuff like that. This is where I think I'm going to find support. Whatever you usually trade around, with this one, I would say if I got into this, if it got above this fib level, I'd probably be out, okay, on Monday. If it gets down here and touches the 61 fib, that's where I'm out. So, I don't risk as much as I have to on the reward side. So if you've been trading, use those type of outs. If it gets above even maybe today's high, if I do this on Monday, if it gets above today's high, I'm out. If it gets, below yesterday's low, these are pretty close to tweezer bottom. If it gets down there, I'm out. To go down there and test that, okay? Generally expensive. Okay, so I answered that one. I thought I might have gotten a new question. I thought I saw something. Is this volume profile free from toss? Yes, it is, TJ. As a matter of fact, I have a short little video on how to set this screen all up like this, and for like whoops, I don't like that. This and where is it? ES. Oh, it's way up here. That's why I didn't see it. Set it up like this where you can get the breakdown of the dailies too. So you can check that out. All right, I keep getting sidetracked. So and we'll go into a little bit more detail on the exit strategy. All these little different nuances. I'm going to pull up the platform and we're going to kind of go over them so that you guys are pretty clear of the concept. All right, max profit is achieved when the underlying goes to zero. That's not where we're going to get out of this strategy. We're not looking for anything to go to zero. When was the last time you saw a stock go to zero? I mean, even everybody thought Kodak was dead, right? Kodak was trading $3 a share. What do they do anymore? Nobody does Polaroid cameras. Well, they came out and said they were going to do Kodiak coin, basically blockchain. And they tripled in one day. So nobody ever goes to zero, do they? But anyway, some of them do. But anyway, the likelihood is very small, and we're not looking to get that. We're looking to make our move, get out for a profit. Beat the probabilities and take our money and run. Max loss is infinite. We aren't going to go that far. We're going to pick our out and get out there. You can't do a stop with these guys, but at the end of the day, know where you're you can set up an alert when the underlying trades to a certain point, that's where you're out. You get an alert, get out. All right, strike price plus the credit. So, we were looking at those. We'll just look at one. So the strike price, whatever the strike price is here, we did the 70s and we got a credit. So our strike is plus the credit, right? 98 cents plus the 70 cents. So 70.98 is our break even. So you add it in, and if we did this as a debit, which would have been doing it like this, doing the 72.5 calls. Did I get the 72.5 calls? Buying the 72.5 calls, we do it as a debit, and it's $1.45. We subtract the $1.45, that puts us at $71.05. So in a sense, we would be selling this slightly higher than where the underlying is trading. So when somebody was asking me which strikes do you pick, the at the monies, at the end of the day, pick those ones that are closest to at the money, and the one that gives you the best price. Like the other one, I was only able to sell it at $70.98, right? Now I'm selling this at $71.05. So I'm selling it, 6-7 cents higher, which all those pennies add up. So if I were trying to synthetically short Las Vegas Sands, I would probably opt for the 72.5 strike rather than the 70s for the reason of getting my break even slightly higher. You want me to do this on the Analyze tab? Sure. So to compare apples to apples, right? We talked about what it costs to synthetically short. I'll do that in a second. We talked about the synthetic short versus the regular short. If I go in here and do the Analyze tab for TOS, as you can see, as the market goes down, I make money. As the market goes up, I make money. Now, you can't really see it, but you can kind of see like a purple and a blue in here. That's not like my computer going out. What that is that is showing you a depiction of what the underlying would be if you shorted it versus what the options would be if you short it. Or do this strategy. And you can see they are lockstep the same. Does that make sense? Do I have any preference, credit over debit? I like a credit, but I always like a credit, right? So, but I like to sell options. So I like to get that credit, but it doesn't really matter. You're still going to have the same margin, everything else. Ultimately, I prefer getting a credit just because I love getting credits. But, in this instance where I was able to get it a nickel or even sometimes a dime higher, then I'm going to go with the debit. Sometimes the credit will make you a dime higher too. So whichever one gives you the best price for selling the stock, right? I mean, if I asked you, do you want to sell this stock at $70 or do you want to sell it at $70.10? What's your answer, right? I know what your answer is. We all want more money, so take it. Profit only if the stock goes down, right? Absolutely, John. That is the nature of the beast here. But just like if you were to go out and buy a stock, you're only profitable if the stock goes up. And if you sell a stock, short a stock, you're only profitable if it goes down. Can retail traders negotiate reasonable commissions from TOS? Yes, they can, TJ. Bottom line is, if you've been with Thinkorswim for a year or whatever, you're not going to get it if you just came over. Unless you might be able to, if you were coming over from another broker and said, hey, my commissions are here, but I want to move my stuff over to TOS because I like your charts and whatever, then you can negotiate it there. But don't negotiate every month with them. Don't beat them down all you're going to do is they're just going to know you at the desk and they're going to be like, no. But if you call once a year and say, hey, last year I did, 4,000 or 10,000 in options, I'd like you to lower my thing. Well, they're probably going to lower your commission rate just so they don't lose you as a customer. So always play that. If you can't watch it every day, would you use a stop loss at your out point? Douglas, if I wasn't watching this every day, you can't really do a stop loss necessarily with this strategy unless you did it with the puts and the calls, and that would get really ugly. What I would do is just give myself an alert. When the underlying trades at this point, send me an alert. In Canada, cost says no negotiate except if you trade a shitload of trades. So it is possible, but that is generally this, even on the floor, the way to negotiate better commissions was to trade a lot of contracts. The guys that traded 1 or 2 lots and didn't trade very many didn't get cut rate commissions, but the guys who, traded 10,000 contracts a month, basically paid nothing in commissions. And that is the nature of the beast. So you can negotiate it, but, pick and choose your timing. All right, so this is usually the time where I throw it out to you guys. We're kind of running low on time. Let's call out some stocks on the line here in the questions box, and we'll throw them up here and see if it fits the rules and see if we can find something good, all right? All right, I see you guys are blowing me up. Give me a second. All right, I got to catch up. All right, a couple of them. Han, somebody likes Honeywell. Sorry, I got a kink in my neck. So Honeywell. Now, Honeywell is 45 cents. I know I've traded Honeywell a lot. I don't know if they're inside of, 14 or 15 cents, 1, 2, 3, 15 cents, generally speaking. It's a little wide. I would say it's probably mostly due to the volatility we're seeing. So I'm going to go with it. But basically what we're going to look is, first thing we're going to do is we're going to try and get, if we sold this underlying, right, we do 100 lot. That's each option is 100 lot. If we're short this stock, the delta is equal to, 1 for 1. So basically what delta tells you is for every $1 move in the underlying, the option price is going to be affected by the delta. So if this goes up by $1 from 147.90 to 148.90, this premium is going to increase by 43 cents. That's what delta is telling you. So in a sense, while the underlying increased by $1, we only increased by 43 cents. Vice versa, if we sold these calls and the market went down by $1 to 146.90, then these would decrease by 43 cents. All right. So we're not capturing dollar for dollar. So what happens? What we do is we go over here and we try and match it up to get 100 deltas. We're buying these deltas. So we'd be buying these deltas. So we're buying 39 deltas. Sorry, why aren't you letting me do that? Buying those deltas. Oh, I know what I did. I held control on accident. We're buying these deltas. So we're buying 39 deltas. So that means we are negative 39 deltas. We go over here and we sell these. So we bought those. Now we sell these calls. We are selling a positive delta. So we are a negative plus a positive equals negative, right? So we're negative 61 deltas. 61 plus 93, or 61 plus 39 is 100. So that is equivalent to what the underlying. So if the underlying went down by $1, our position would profit by $1. Vice versa. The underlying goes up by $1, we lose by $1. Okay, so it's basically that simple. We can set it up. We look at it. One lot, 253 credit. So a 253 credit we add to this. So we are selling this at 147.53. So 147.53 is slightly worse than where it's trading. So we'd have to, well, the market's really wide right now. But we look at this, last trade is 147.90. So 147.53, we'd be selling it almost 50 cents lower than where the underlying is trading. So let's look at this one. This isn't going to give us 100 deltas because if we buy this one, we're getting short 56 deltas. and we sell this one, we're getting short 43 deltas. That gives us 99 deltas. So for every dollar down move, we're only going to increase in value by 99 cents. That's what I was talking about with it. Doesn't always come out exact, but 1 penny here or there, you guys aren't going to notice that, right? But now we've done it for a debit. So as a debit, we have to subtract it from here. So $150 minus $2.60 puts us at 147.40. So 147.40 is a little worse even yet still. So that one we're going to have to probably go with, I'd probably go with the 100 deltas, and it's a little higher. Go with that one. Does that make sense for you? Finally made it in after so many weeks of listening to the recordings. Thanks, Parshed. He's finally back. All right. Win. I'd go with win, Wally. I like your thinking. I was saying in my daily market commentaries, I actually tried to get long Win for a short bounce because I thought they were going to bounce off Steve Wynn retiring for a short time. But I was like, long term, I'm bearish because Steve Wynn is Wynn Casinos. I mean, he's got the best casinos. You take out the best guy in Las Vegas and you think things are going to get better. But it's found a lot of support here on this 38, but let's just say we wanted to get shorted. I'd say on this, it's found resistance here on the value area high. I'd be out here, so if Win goes up to 177, I'm out. I write that down. My exit on a loss is 177. 150 would probably be somewhere where I would look to get out. I'm probably thinking that Win is going to go down here. And I've talked about this to about 135. So I would probably be out here on the upside, maybe take half off here and hope that it goes down to the 61 for that move. So I like Win. I've been kind of looking at it, looking for an opportunity to get short this now that I got punched in the face not too long ago. So let's look at Win. Win's trading 166, move the decimal place 3 ticks to the left. It should be about 16 cents wide. Of course they're not. But that's because of volatility right now. So I'm going to go with it anyway. So 45 deltas, 55 deltas, that gives us 100 deltas. We can even get 100 deltas out of this one. So let's look at it. Let's look at both of them, to be quite honest. So it's trading 166.22. We buy those, sell those. We got an $8.80. Oh, that's not right. Buy those, sell those. Got a dollar credit, so 166 is our break even, slightly below where we're trading right now. So let's try this one, buy this one, sell that one, just see what we get. 170 we subtract. Come on. $3.91 debit. So we subtract. We get $1.70 minus $3.90. That gives us 166.09, right? So that one's better. 166. It's still slightly below where we are, but it's basically the bid. We'd be selling the bid. And that would probably be the one I go to because that's 100 deltas there. It's going to line up just the same as we would see in the Analyze tab. Again, looking at Vega, a 21 Vega here, 21 Vega here, those offset. We bought one volatility, sold the other volatility. We don't care what volatility does. Theta, we offset it. We don't have to worry about theta decay. All right, so we've got both of those things going for us. Look at the Analyze tab. It's going to give us the same market profile. You can see that we benefit same as a short stock position. Back to the trade. There was something I wanted to say here real quick, and I don't slip my mind. Maybe I'll think about it here in a second when we go on to other things. And some of this, us being below where the market is currently trading, has to do with why these are really wide. And as a matter of fact, I tried to get out of something today. The markets were really wide, and I gave up too much edge. I put in an order. I did a cancel replace once, but I went down a nickel and got filled immediately, and no, I gave up too much edge. So anytime you're doing this, if you're paying a debit, you crank that down, pay less than what you think. Why is that going up when pay less of a debit? pay less of a debit than what you think you can get filled for, okay? And then cancel replace, because as soon as you get hit right away, you know you gave up some edge. But that win, dude, cost me a lot of money. Well, you know, that's why he runs a casino, is because he knows he's got the probabilities. Oh my gosh, I just got a bunch of them. Stocks beat. Sorry, selling a call. I, for some reason, lost some things there. Lost some questions somehow. They got all jumbled up. Maybe I hit something there. I think I hit the time on this. Sorry, you guys. All right. Sorry, I jumbled up all your questions. Got out of order there. All right. TLT. Somebody's bullish TLT. TLT will work. If you think, or bearish, I was thinking TBT. If you think interest rates are going to continue to go up, which the Fed said they're going to continue to increase interest rates, that is bearish for TLT. As interest rates go up, bond prices go down, the coupon price goes down. So that would be a perfect scenario for TLT. If you think interest rates are going to continue to rise, then this would be a good trade. Let's just check our deltas. There's 99 deltas on that one. This one's 49 and 51. That's 100 deltas, so that's the one I'm going to look for. So I'm going to buy the 118s, sell the 118s. That gives me 100 deltas. All my Vega is offset. All my Theta is offset. And another thing, I'm looking at the 35s. If we're offsetting Theta, we can go further out too. So let's just look at an example further out the line. So let's look at the same ones. I think I was looking at the 118. So let's look at the 118s, 51. We got 100 deltas. So buy those, sell those. 8-cent debit. On an 8-cent debit, we subtract, right? So 118 minus that 8-cent debit. We're very close to where the underlying is trading there. So we're good. Okay, Farshid, you answered your own question. Isn't negative $2.6 credit? You know, when it does that, that was actually a credit. I don't know why it was giving me the negative credit on that, because it was should have been a true credit, I believe. I didn't look at it that closely, but I believe it should have been a credit. Sometimes it does that, and it's like two negatives make a positive or something. I don't know. I've asked them about that too before. I'll go back and look at it here in a second. We'll just double check it. So very close to where the underlying is trading. So go further out on the curve. It doesn't hurt you, right? Still a 5-cent debit. You know, that's all you're paying for it, and your margin is going to be the same as well. So, or at least very close. So I wouldn't worry. Go further out on the curve for it. All right. So if a TLT, one of the first things I would look at, though, if I was going to do the 118s, pull up the charts. Actually, the tools on accident. TLT, you know, maybe I would say if I was going to get short this, if it goes below 116, I'd probably look, or comes down and trades 116. That's probably where I'd get off, because that's going to act as support. And the upside, I'd probably look at this. If it, you know, especially because it looks like it may have bottomed a little here, I'd probably get out if the underlying traded above today's high. And I'd write down both those prices. I'm out at 116.49 and I'm out at 19.13. Risk rewards on that's not very good though. But that's how I'd look at it. And I might not take this trade because of that, because my risk reward, I've got, $1 something to the upside. I guess I got a little better than $1.50 to the downside. So it's basically 1-to-1, which is, the risk, your probability of success with this strategy. We're risking one to make one, and it's a 50-50 shot. Is it safe to use 1 or 2 weekly credit spreads with this volatility? Yeah, you can use this strategy with any option. You can go in short term. If you wanted to do this as like a day trade, you could get in and out of this as a day trade if you wanted to play it that way, yes. Yeah, you got to worry about the day trading rules and stuff like that, but Does that make sense? All right. Does this strategy work good with high implied volatility percentage? It works with any implied volatility. It literally negates it by doing this. When I was talking about with the volatility, the Vega being 24 and this being 24, those offset. So this completely offsets each other. Can you explain when you look at the break even on a credit versus a debit and compare the stock price, what are you looking for or comparing? Thanks. Yes, I will. So let's look at this again. So when we're doing a debit, when you do a debit, remember, hold on. Well, don't freak out on me now. When we're doing a debit or a credit, as you can see here, you add the credit, subtract the debit, right? You can see that show up for here. So, you know, if I'm doing the 118 calls and puts, we're doing the same strike. So basically, when I do it for a debit, I've got to subtract it. So I subtract the debit from the strike. All right. So 118 minus 9 cents puts me at 117.91. And so that's really close to where the underlying is trading. Okay, so we're basically selling the stock for what it's worth. Sometimes you will be able to get this better where, let's just say, you know, you did it for nothing. You know, if you did this for 0, then we'd be selling this underlying at 118. And this is possible. This is definitely possible. As you can see, these are really wide markets right now. So, you know, I would probably start off with maybe even doing it for 0 or even maybe a little bit higher for a creditor. But let's just say if you did it for 0, your break even is 118, right? So our break even is above basically where the underlying is trading. We were doing it for a debit of like 5 cents. So we subtract that debit from the underlying to get our break even. If it is a credit, if it's a credit, then we add that in. So our break even would be, if we got a credit, our break even would be 118.08. Does that answer your question, Wally? This is a stock replacement technique. So there is no volatility impact. Yes, absolutely. Just like there's no volatility, volatility doesn't necessarily affect the underlying, right? That stock doesn't change price based on what volatility is doing. This doesn't either. That's why it makes it a very good surrogate for the shorting stock or shorting futures or shorting ETFs, any of that stuff. Shorting futures is a little bit easier than shorting a stock, but shorting the option or shorting the stock, you know, you have to borrow stock, you have to carry costs, you have interest, you have to pay the dividends. All of this is clean, like as clean as you can get, and as easy as you can get. Down $1, you make $1. Up $1, you lose $1. Can you explain why you are a sell and a buy at the same time with respect to the stock movement? Well, I don't know if I'm going to answer your question correctly, but I believe you're asking why am I going to buy this option, sell this option? That's to get, so for every dollar move, if it all has to do with these deltas. Remember, this is a negative delta. And the reason why delta is negative over here is because the market's always considered to go up. and or when the market goes down, these deltas add into the price. So the delta tells us a lot of different things, but one of the things it will tell us, if the underlying moves up by $1, this premium is going to move up by the delta. So if this underlying moves up by $1, this premium is going to move up by 49 cents. Okay? Vice versa, if this underlying moves down by $1, this premium is going to go down by 49 cents. So as this premium goes down by 49 cents when I sold it, okay, and this premium, because I did the ones, did I do the 118s? 118s, I buy that one, okay, So now this premium will go down by 51 cents, or go up, go down by 51 cents if the market moves up, and goes down by 51 cents when, goes down by 51 cents when the market goes up, and goes up by 51 cents when the market goes down. So these two are synonymous in a sense, right? The market goes down, this goes down by 49 cents, this goes up by 51 cents. Our strategy increases by $1 with $1 move down. Does that make sense? Some people are like, no. So delta is the rate of change of the option contract, okay? And everything's assuming the market's going to go up, okay? So the idea here is this premium on the 118 call is going to increase by 49 cents if the market goes up by $1. If this market, TLT, goes up by $1. This one's saying if the market goes up by $1, this is going to decrease by 51 cents, okay? Well, we think the market's going to go down, so we're going to buy that negative delta. We're going to buy that negative delta, so we want it to go down, and we're going to sell this negative delta. So, right, we're going to buy a positive plus a negative equals a negative. Now we're going to sell a positive, which equals a negative, right? So now we have negative 49 plus negative 51. We are negative 100 delta, meaning market goes down by $1, our strategy increases in value by $1. The market goes up by $1, our strategy loses by $1 because we are negative delta. Negative delta means you are bearish. Positive delta means you are bullish. I clear that up? What was that? But if you think the underlying is going down, why not buy a put with a bigger delta? Great question. Well, you're talking about going into the money. For one, it's really difficult to go in here and buy a 100 delta. You are going to be paying through the nose, for one. And that's going to be a lot of margin, as a matter of fact, when you get that deep. I mean, you're going to be really deep before you get to 100 delta. So that being said, you also have, you kind of have a synthetic stop when you do that, but you're never going to let it go 145, right? Before you get out of this strategy, before you decide you're wrong, you're going to get out well before that. But same thing goes here. We want to capture all of the delta move. The other thing is this volatility, you go in there and, let's just say you didn't do 100 delta, but you just said, hey, I'm going to buy something in the money because I want to capture that move and get almost dollar for dollar. Well, in high implied volatility environments, the premiums get pumped up, and we're offsetting all of that stuff by buying one, selling the other. We're offsetting theta decay, we're offsetting vega, because remember theta decay here, we're offsetting it. That's actually that's not being offset, which is a little strange. I have a feeling the reason why is because this market's really wide. This theta should probably be -2, but you're offsetting theta. Okay, whereas over here, there's theta in here, and that's the extrinsic value. There's, the floor trader hack is look across, and this is your extrinsic value. Well, extrinsic value increases when volatility increases. So if you buy a put in the money and volatility comes out, you're going to lose money, even if you're directionally right. If this goes from, volatility just sucks out tomorrow and, goes back down to where we've seen it for the, better part of this year, these premiums are probably going to be about 50 cents or something. So you're going to lose 50 cents on your premiums. It's just going to get sucked out. So you could be directionally right and lose money when you buy options in high implied volatility, which is kind of like that little rant I had at the beginning with Fidelity saying that, those guys couldn't short options. Well, that forced them into going out and buying options. in a sense, if they like to trade options. So now they're buying options in high implied volatility, which is devastating when volatility comes out. Okay. So it's okay to say short call, long put equals short stock. Yes. Yes. And, you know, I mean, it's kind of like one of those things where we were talking about with the risk reversal as well, where you get a little further out, and it's very similar. Disadvantages, if you're wrong on direction and you hold a naked call, not a good situation. Stefan, absolutely. If you are wrong in this strategy, you are wrong. And if you're right, you're right. And it's just like it's a 50-50 probability of success. I mean, that is the probabilities. And just like a stock, you buy a stock, it's a 50-50 probability. And that's the probabilities. Synthetic long, if you're doing a synthetic long, you're naked short a put. So if it goes down, that's bad, right? Just like a stock goes down, that's bad. You're not safe until it hits, or you're not going to stop feeling the pain until it hits zero. What's that? Same 2-day with calls as market went up, volatility decreased, and the calls barely moved. Yeah, that's an perfect example. JQ is saying, saw that 2 days ago with the SPY calls. Volatility, the market started rallying, volatility started coming out, because when the market goes up, a lot of times volatility comes out. Those calls didn't change because the market was moving higher, but volatility was coming out, so the price was actually being offset by volatility. The price moving up was being offset by the volatility moved down. It's very difficult. Easier and cheaper to get out of a stock than an option, something to consider. Well, in a sense, it depends on what stock we're talking about. A lot of times getting out of options is as easy as getting in and out of stock as far as I'm concerned. I mean, especially the ones I'm trading. If you're looking at my watch list, all of these are very highly traded options. TLT and TBT should be over on my side, but we can look at volume and open interest and see there's pretty good volume. Even out here 98 days, there's good volume and open interest. We look in close here, this is going to be huge. And basically, you can look at this and know that all of this volume and open interest is going to slowly move into this area here. So it isn't too difficult as long as you go with that one rule. Remember that rule I talked about. Don't get into options that have wide bid asks. You know, and it does, that rule 10 cents wide does not apply to out here. When you make that rule of picking the right underlying, look at around 35 days and say, all right, am I 10 cents wide on the bid ask or 11 cents wide because it's over $100? You know, it's not meeting that rule. It's a Friday after the close. We have super high implied volatility. Markets are wide right now, understandably. But it's a rule of thumb to keep your eye out for. Don't be trading them if it's like 50 cents or $1 wide on a $100 stock. That just doesn't make sense. Okay. Anybody else have any other questions real quick? So it is a high risk strategy, and you have to be right. It's dollar for dollar, you guys. I'm not going to lie to you. It's risky, but this is a bearish market assumption. You need a little bit higher risk tolerance. But if you've been trading options for a while and we're in a bear market, this is a good strategy because, being long stock in a bear market is not a good strategy, is it? If it's 50-50 risk reward, what is the advantage of using this strategy? Well, the advantage is you're getting dollar for dollar move, whereas high probability strategies, you are going to get that dollar for dollar move, right? So we're increasing our risk to increase our reward. That makes sense? Do I truly believe we're in a bear market? No, not yet. I think we're in a correction. I don't think we're in a bear market. I think the economic data coming out is too good, which is why I thought I thought we were getting that balance. I mean, if you guys, how many of you guys are watching the daily market commentaries just out of curiosity? But if you look at the markets, we can look at the markets on the balance. Let's just look at the ES, because this is what made me make this decision. The ES was like, it came down, bounced off the 200-day moving average, started rallying. The next day we pierced above this, and I was like, we are off to the races. And I started getting short puts in just about everything, not in necessarily, I did get short puts in SPY. And then I got this snapback and covered yesterday. Basically, it was just leveling my position, just getting out of everything. It was a fire sale. But, you know, today we get the volatility coming out. So I don't think we're in a bear market. I think we're going to kind of bounce around. I wouldn't be surprised if we do break below this 200-day moving average and settle below there. I think it's coming down to the point of control. But I was thinking we are going to kind of do a bounce and start like working our way back up again. When do you do the daily market commentaries? I'd usually get them out around noon or 1 Eastern. And I talk about every single trade I do, whether it's a winner or a loser. And if you guys were watching those daily market commentaries yesterday, I was talking about a bloodbath. Actually, it was today I talked about it, about my getting out of all my losing trades. But, you know, I'm not that guy that's going to go out there and tell you guys the best trades. You know, like, hey, dude, you know, look at this synthetic short. This would have been a huge winner in ES. Look at that. You would have made, you know, $3 million had you just followed it and just done a synthetic short at the top. You pick the top or you pick the bottom, where some of those guys out there do that. I don't, you guys. I go out there and I tell you what I did today, and then I tell you where I got out of it, what day I got out of it. I got out of all of those like XOM, SPY today, and I talked about it today. Although I got out of those yesterday and talked about them today, because I literally got out of them at the last minute of the day yesterday. So how do you sign up? You can reach out to us. Email us at trading@protraderstrategies.com, or the best way really is to call us at 310-598-6677. You can get those. You have to sign up for them though. But this is the package we're doing right now, you guys, how to set up your screen. Somebody was asking about TOS and how to do the market portfolio. That's in here. So for 36 bucks, you know, protecting your portfolio against rising interest rates. We were just looking at TLT. If interest rates go up, we talked about this, it's like a teeter-totter. Interest rates go up, those prices go down. And yes, you can hold it for 30 years, get your par value back for it. But in the meantime, if you're looking at yield, the value, you can't chase yield. It is impossible to sell a 3% bond and buy a 4% bond to get that coupon and make money. Because wherever you bought that 3% coupon is now lower in value, and you're going to lose more money than you can make up in like 20 some years on that bond that you just bought. So it doesn't make sense to chase that yield. The best way to make up for that loss of the coupon is to trade like I talk about in this video here. So for that $36 alone will save portfolios dramatically. So there's all kinds of over 20 videos here for 36 bucks. You guys should take advantage of it. And while you're calling in, oh, sorry, somebody's asking how do you get this offer. I basically put it out into the chat window. There should be a link in there for this. If you're watching this tomorrow, you can do option courses, how to trade options like the Wolfman in your URL. Just pause it, type that in there. Easiest way to do it is click on that chat window and it will fire you right off to this page here. So I just double checked to make sure it's working. So take advantage of this, you guys. It is a great entry to options and everything else. And this one alone is a great webinar that everybody needs to really look at, because think about your portfolio, how much bonds you have in there. Most people are like 60-40 or something like that, 60 maybe, or 80-20, but that 20% bond portfolio is going to get decimated. And I show you the charts on it and how you can't chase yield and all that stuff. So basically, I mean, don't you guys, I talk about probabilities. Now, I get that this strategy is one of the lower probability strategies, but we are going for, a big, we have a big bearish market assumption with this, and it's the best way to take advantage of it. That's why I want to teach it. I trade synthetic shorts all the time. So if you guys really need to be trading with this knowledge and everything else that I teach, because I talk about the probabilities and how to increase those probabilities. So if you guys enjoyed my instruction, especially if you guys are one of my regulars, you guys should be taking advantage of that, and just go over to the chat window, click on it. We're talking back and forth here in the questions box, but over there in that other section, you can see a little chat window you can click on. But the best way to become a better trader, you guys, is to constantly learn, which you guys clearly have done by taking this webinar, of course. But wouldn't you say that just knowing how to trade an option strategy, just going out there, I can find out how to do a synthetic short online, but they're not going to tell you all of the different nuances that you need to know to be comfortable with trading this strategy. So, trading with that kind of knowledge is very important. So basically what I mean is, if you're trading with technicals or building strategies, trading the probabilities and becoming more mechanical is the best way to become a better trader and to get ahead in this game. And being mechanical even means writing that stuff down, you guys. Writing it down on a piece of paper. I can't emphasize that enough. If you have it in your head, especially with this strategy, saying, I'm going to get out at this level, and it goes to that level, and it's only in your head, you're going to have a tendency to squeeze it out a little bit longer, you guys. If you write it down, it's going to be burning holes in you. You're going to be like, oh, I got to get out. I got to get out. I got to get out. And you will. And never look back, because it doesn't benefit anybody. There's going to be 50% of the time you get out at the right time, and 50% of the time you don't get out at the right time. But the 50% of the time you get out at the right time is going to make up for all of those times where you squeezed it out and it went against you. Or, you missed out on left a couple of pennies on the table. I don't worry about that. Just get out. All right. So I teach it that way, how to play the probabilities, when and where I find them, when they've gone against me, what to do. And when you're trading with the right tools, you guys, for the right situation, you're going to be more productive state of mind. You guys are going to be able to put on more strategy, which creates more opportunities, and ultimately is going to build your confidence. So I know this is a scary one. This isn't necessarily, if you are like a brand new options trader, maybe wait a little bit while, let it meld, keep an eye on it, maybe trade it in a paper trading account or something like that to get used to it. And then, start implementing it if you want to. We're offering this today, so take advantage of it, guys. That's about it. If you learned anything at all today, even if you're a savvy trader, you can click on that link, and I'm sure you're going to learn something new too. All right. So one last thing, I just want to thank you guys all for attending. Later webinars, I'm going to be drilling down on options components, how to trade options, when and where I find them appropriate. Here's also the link. It's not a hot link or anything. You're going to have to pause it. And I want to thank you guys all for watching. If you have any questions, reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. And you can use both of those two things to reach out if you guys, I know I see a lot of people are asking about the daily market commentaries. So please reach out to us, and we'll straighten all that out to you. Yes, this is a one-time charge on this, and you get all these videos. And what's really nice is you go on the website, you log in, and there's like a little box here by each one of these 20 different videos. And once you've watched it, you just click on it, and it puts a little check mark in there, show you've already watched it, so you don't have to deal with like, oh, did I watch this one? I've been skipping around, I can't find it. It totally gets rid of all that. Thank you, Farshid. I appreciate your kind words. If this is a bearish strategy, how does a bear call spread compare to it? Pros and cons. Bear call spread, with a bear call spread, you have a higher probability of success with a bear call spread. So that is a negative for the synthetic short, right? A bear call spread will work good in a high implied volatility environment, not so much in a low implied volatility market. So you have to know what environment you're in and when and where it's appropriate for that strategy. So that's a plus to the synthetic, I guess, because you don't have to worry about it. The short call spread, you're getting a small credit, right? You're not getting, and that's your max profit is like $1. So if you're, directionally right, you get that dollar, you get to keep that dollar, and that's about it. This, you have a lot of profit potential. So higher risk, higher reward, lower probability of success with this strategy, with the synthetic short. I demand with a lower probability of success and a what was I going to say? Lower probability of success with this strategy. I need to have a higher reward, right? So with the call spread, you have a lower reward but a higher probability of success. There's always trade-offs, you guys. You always have to weigh the balances here, For SPY, Chuck, I probably would go with a short call or a short call spread around SPY. If I was bearish with this super high implied volatility, I can't get around it. When we're setting up these webinars, like, months in advance for when we're going to do them, I don't really know what the environment's going to be right then, right? So it's kind of like take what we can get. But we can isolate volatility with this. What else is there? So all of those things you kind of really weigh. What about butterflies? Butterflies are great for sideways market, and I've done webinars on those, and I think they're coming up pretty soon that I'm going to be talking about those too. What else is there? Is it a one-time charge? And no, yeah, I already answered that. Thank you, Andrew. Appreciate it. Thanks, Chuck. All right. If you have time before the close, can you clarify this? When stock goes up, say $1, the call side goes down in delta and the put side goes up by its delta. How do they add up to $1 move? All right, I'll do that in just a second. And that you're kind of backwards on that, so that's why I want to explain it a little bit more. Would ES be better than SPY? Not necessarily. If you have a membership at the Board of Trade, then definitely it would, because you'd get a lot lower commissions. ES is also a lot bigger than SPY. So if you're doing SPY with like 10 lots or something like that, then yeah, you might definitely look into doing ES, because then you could do a 1 lot and your commissions would be a lot lower. How about weeklies? Yeah, you can definitely do this with weeklies. All right, appreciate it, Offer. So here, I'll go over this real quick again. I know we're way over time here. Oh my God, this is like the longest webinar ever. Real quick, I'm going to go over it. The way that these add up, okay, the thing to remember is markets are going to move. So my platform is going to freeze up on me. So I'll try and explain it out loud. All right, here we go. ES, I don't want an ES. I'm going to do SPY. All right, so SPY. One last time on the deltas. Okay, so delta tells us for every dollar move in the underlying, whether it's in either direction, delta is going to affect our premium by that amount. So the closest to at the money is always going to, or the at the money is going to be the 50 delta usually. I don't know why I thought I saw 50 there for a second. So if we're looking at this strike here, the 162 calls, if the market goes up by $1, these premiums are going to increase by $1. And the way that this market goes, if it goes down by $1, these will decrease by 52 cents. And that's only on the first dollar move, okay? I'm not going to get into the gamma and stuff right now. But so this market goes down by $1, this premium goes down by $1. If we're short this premium, we want that to go down by, or sorry, I misspoke. If the market goes, if the underlying goes down by $1, this premium will go down by 52 cents. And we want that, right? Because we're short deltas. We want this to go down in premium because we're short premium. We collected a credit for this. We want this to go to zero. Now, if we then go in and buy these here, then we want the market to go down because we buy puts, we want it to go down. And for that first dollar move, this premium is going to increase by 48 cents. Okay? It's going to increase by 48 cents. So if this increases by 48 cents and this decreases by 52 cents, what did we have? Or if this goes, we've collected a dollar, right? This increases by 48 cents and this decreases by 52 cents. That's a dollar move, right? Does that make sense? Okay. So add up the deltas. That can tell you what your deltas are. If you're buying puts, you are bearish, which is negative. So, you have negative deltas. Right? If I sold these puts, negative plus a negative delta means I'm positive deltas. So I want this market to go up, to have these premiums decrease by that amount, right? It's like if I sold calls, it's a negative plus a positive is a negative. So these are negative deltas. I want it to go down. I'm negative delta. I'm bearish. That's what I was talking about when you're really long your portfolio. Everything is positive delta. You do need to add in some negative deltas. All right. So I hope everybody took advantage of the link there. If you guys already took advantage of that link and want to get the daily market commentaries, reach out because there's a lot that comes with those daily market commentaries. I mean, it's everything daily. I talk about all the economic data, geopolitical stuff, where I think the markets are going, and putting on trades. And I talk about when I get in, when I get out. So I hope you guys all learned something in this massively long, probably the longest webinar I've ever done. That's all I got for you guys. If you can't take that, take it easy. Have a great weekend, everybody. Thank you, JQ. Appreciate it. JQ is blaming me for not starting dinner yet. Yes. Hold on, honey. He's gone 45 minutes over. He won't shut up. Sorry, guys. Take care. Thank you. I appreciate it, guys.